Central banks are buying gold at the fastest pace in half a century, while telling you their currencies are perfectly stable. In 72 hours last March, the Federal Reserve, European Central Bank, Bank of England, Bank of Japan, Swiss National Bank, and Bank of Canada quietly created unlimited emergency currency swap lines and called it precautionary. They're not protecting your savings, they're protecting something else. This isn't about inflation numbers or interest rate policy. This is about coordination. When the world's most powerful financial institutions move in perfect synchronization while building emergency systems they won't explain, they're not being cautious. They're preparing. And what they're preparing for will determine whether you survive the next decade financially intact or destroyed. March 19th, 2023. 11:47 p.m. Eastern Time. Most of America is asleep. But in a conference room at the Federal Reserve Building in Washington, in a similar room at the European Central Bank in Frankfurt, in the Bank of England, the Bank of Japan, the Swiss National Bank, and the Bank of Canada, officials are on secure video connection. They've been on this call for 6 hours. At 11:58 p.m., they issue a joint statement. 73 words. No press conference, no explanation. The statement announces the establishment of standing swap line arrangements, permanent, unlimited channels to exchange currencies with each other at a moment's notice, any time, for any reason. The financial media barely covers it. By morning, it's buried under headlines about tech stocks and Fed rate decisions. But that 73-word statement represents something that has never happened before in the history of central banking. 6 of the world's most powerful financial institutions just created a permanent, unlimited emergency funding mechanism, and they called it precautionary. Think about that word, precautionary. When was the last time central banks built something precautionary and never used it? The answer is never. Because central banks don't build infrastructure they don't plan to deploy. Every emergency facility they've ever created, the term auction facility in 2007, the primary dealer credit facility in 2008, the commercial paper funding facility, the term asset-backed securities loan facility, all of them were described as precautionary. All of them were activated within months, sometimes weeks. So when 6 central banks coordinate across time zones to create unlimited swap lines in the middle of the night and call it precautionary, they're not being careful. They're being strategic. They see something coming, something big enough that they need every major central bank coordinated and ready, something they clearly understand but cannot publicly acknowledge. And here's the part that should terrify you. While they were building this emergency system in secret, they were also buying gold. Lots of gold. Rebecca Martinez still remembers the exact moment she realized something was wrong. She's a 41-year-old treasury analyst for a mid-size bank in Charlotte, North Carolina. Her job is monitoring central bank activity, watching their balance sheets, tracking their asset purchases, analyzing their policy statements. In January 2023, Rebecca was reviewing the World Gold Council's quarterly report on central bank gold purchases. The number that jumped off the screen? 1,136 tons purchased in 2022. That's the highest annual central bank gold buying since 1967. Rebecca had to read it 3 times, because 2022 was the year every central bank was publicly claiming victory over inflation, insisting their currencies were strong, telling markets that monetary policy was working exactly as designed. And yet, they were buying gold at a pace not seen in 55 years. Rebecca pulled up the detailed data. The People's Bank of China added 225 tons. Poland's central bank increased holdings by 130 tons. Singapore, India, Turkey, the Czech Republic, all loading up on physical gold at record pace. She cross-referenced this with their public statements. Every single one of these banks had issued communications in 2022 describing their currencies as stable, their inflation as transitory, their systems as sound. But they were buying the one asset you only buy when you don't trust your own currency. The contradiction kept Rebecca awake that night. If your currency is fine, why buy gold? If inflation is transitory, why stockpile the inflation hedge? If the system is stable, why are you quietly preparing for instability? Here's what most people get catastrophically wrong about central banks. They think central banks are reactive, that they respond to crises after they happen. But central banks don't work that way. They're not firefighters who show up after the building is burning. They're the people watching the building, seeing the electrical wiring overheat, smelling the smoke in the walls, and quietly installing sprinkler systems before anyone else notices the danger. The emergency infrastructure they build tells you what they see coming. And right now, they're building infrastructure for scenarios they won't publicly discuss. In July 2023, the Bank for International Settlements, the central bank of central banks, the institution where global monetary policy is actually coordinated, launched something called Project Phoenix. Not a typo, Phoenix, rising from the ashes. Their official description, a vision for the future financial system, buried in the technical documentation on page 47 of a 73-page white paper that almost nobody read, is this phrase: capable of operating during periods of financial instability or infrastructure disruption. Read that again. They're building a backup financial system, a parallel infrastructure designed to function when the current system cannot. Why would you need a backup unless you expect the current system to fail? Why would the most powerful financial institutions in the world spend millions of dollars and thousands of hours building redundant payment systems, redundant settlement mechanisms, redundant everything, unless they believe the primary system is fragile? Contrast Rebecca's discovery with what happened to Michael Patterson. Michael is 34 years old, a financial advisor in Denver who manages retirement accounts for middle-class families. Teachers, nurses, small business owners, people with $200,000 to $800,000 in retirement savings, who were counting on that money to fund the next 30 years of their lives. In March 2023, the same month central banks created those unlimited swap lines, Michael attended his firm's quarterly meeting. The presentation from headquarters was titled Market Outlook, Steady as She Goes. The chief investment officer stood at the front of the room and delivered 23 slides explaining why the Fed had inflation under control, why the banking system was sound after Silicon Valley Bank's collapse, why client portfolios were positioned correctly for a soft landing. Michael took notes. He believed every word. He went back to his office and sent emails to his clients, reassuring them that despite recent volatility, the fundamentals were strong and their long-term plans remained intact. Michael didn't know about the swap lines. He didn't know about the gold buying. He didn't know about Project Phoenix or the BIS white papers or any of the infrastructure being built in the shadows. He knew what his firm told him, which is what the financial media told them, which is what central banks publicly stated. Everything is fine. The system is stable. Stay the course. Two people, same month, same economy, opposite information. Rebecca sees central banks coordinating emergency systems and buying gold while claiming stability. Michael sees official statements and reassuring presentations. One of them is about to be proven catastrophically wrong. But here's the question nobody asks. If central banks are preparing for something serious enough to require unlimited currency swaps, record gold purchases, and backup payment systems, why won't they tell anyone what they're preparing for? The answer is simple and chilling. Because the moment they publicly acknowledge the danger, they trigger the crisis they're trying to prevent. If the Fed announces concern about Treasury market dysfunction, investors immediately sell treasuries, causing dysfunction. If they admit worry about commercial real estate loans, depositors run from regional banks. If they acknowledge doubts about dollar reserve status, foreign central banks dump dollar assets overnight. They're trapped. The system only functions as long as everyone believes it's stable. The moment they admit it's not, the game ends immediately. So they do what they've always done. They prepare in secret, build the infrastructure, coordinate internationally, buy the safe haven assets, all while maintaining the public narrative that everything is under control. And here's the part that should make your blood run cold. This pattern has a name, and it has a 100% historical success rate at predicting catastrophic financial crises. Because every single time central banks have coordinated in secret while building emergency systems, what followed destroyed the people who trusted official statements and enriched the people who watched what central banks did instead of what they said. The swap lines are active now. The gold vaults are full. Project Phoenix is operational. The rehearsals have been conducted. The coordination is complete. All while your financial advisor sends emails about steady markets and soft landings. One of these narratives is true. The other is a carefully constructed lie designed to prevent panic until the infrastructure is ready. And if you can't tell which is which, you're about to learn an expensive lesson about the difference between what central banks say and what central banks know. Because they're not planning for a crisis, they're rehearsing for one. And when central banks rehearse, it's because the performance date is already scheduled. There's a pattern that repeats every time central banks coordinate in secret, and it's repeated with perfect consistency for the past century. The pattern has 3 phases. Phase 1. Coordinate secretly while building emergency infrastructure. Phase 2. Tell the public everything is fine while privately acknowledging severe risk. Phase 3. Deploy the infrastructure during crisis while acting surprised. Every major financial catastrophe of the past 100 years followed this exact sequence. And we're currently in phase 1 of a cycle that looks identical to 3 specific historical moments. Let me show you. May 1927. The Federal Reserve Bank of New York hosts a secret meeting. Attending are Montague Norman, Governor of the Bank of England; Hjalmar Schacht, President of the Reichsbank in Germany; Charles Rist, Deputy Governor of the Banque de France; and Benjamin Strong, Governor of the Federal Reserve Bank of New York. No minutes are published. No press is allowed. What we know about this meeting comes from documents that leaked decades later, and from the private papers of the attendees discovered after their deaths. The agenda: coordinate interest rate policy across all 4 central banks to support the British pound, which is struggling after Britain's return to the gold standard at pre-war parity. The pound is overvalued. Britain is losing gold reserves. Norman needs help. So these 4 men, representing the most powerful monetary authorities on Earth, make a decision that will kill millions of people. They agree to simultaneously lower interest rates in their respective countries to make the pound look more attractive by comparison. Picture this as 4 water towers of different heights. The British Tower is emptying fastest because water flows to lower levels. Their solution isn't to fix the British Tower. It's to lower all the other towers simultaneously, so the British Tower looks relatively full. The result? Coordinated easy money policy floods into an already overheated credit boom. Stock prices surge. Real estate speculation explodes. Margin debt reaches levels never before seen. And on October 29, 1929, the entire structure collapses. The Great Depression follows. Unemployment hits 25%. Banks fail by the thousands. The global economy contracts by 15%. 50 million people will eventually die in the war that economic desperation makes possible. But here's what matters for our story. The central bankers who made that 1927 decision knew they were taking risks. Strong's private correspondence, released years later, shows he understood they were gambling with civilization to save the pound. They coordinated anyway, in secret, while telling the public that monetary policy was sound and the boom was built on solid fundamentals. And when it collapsed, they acted shocked. Now jump forward 40 years. March 1968. For months, central banks have been meeting in Basel, Switzerland, at the headquarters of the Bank for International Settlements. The topic? Defending the gold standard. Since 1944, the Bretton Woods system has pegged global currencies to the dollar at fixed rates, and the dollar to gold at $35 per ounce. But America has been printing dollars to fund the Vietnam War and Great Society programs. Those excess dollars are flowing to Europe. European central banks can exchange those dollars for gold from the U.S. Treasury at the fixed $35 rate. They're doing exactly that. The U.S. gold reserves are hemorrhaging. So the central banks create something called the London Gold Pool, a coordinated intervention where 8 central banks collectively sell gold into the market to suppress the price and maintain the illusion that $35 can still buy an ounce of gold. Visualize this as 8 people standing around a dam that's cracking, each holding a bucket, frantically throwing water back upstream to maintain the lake level while the dam crumbles beneath them. For years, they sell gold. For years, they issue statements saying the system is stable. For years, they coordinate these interventions in secret meetings at the BIS that have no public record. And then in August 1971, on a Sunday night, President Nixon goes on television and announces the United States will no longer convert dollars to gold. The gold window is closed. The Bretton Woods system is dead. And every person who trusted those central bank statements about stability just watched their purchasing power begin a decline that continues to this day. The dollar has lost 87% of its value since that Sunday night. Not through default, through debasement. Legal, systematic, coordinated debasement. Here's the first mini-climax and the pattern that connects to today. In both 1927 and 1968, central banks saw the crisis clearly, coordinated their response in secret, built the infrastructure to manage it, told the public everything was stable, and then deployed during crisis while acting as if nobody could have predicted it. The mechanism is always the same: coordinate, build, deny, deploy. And we're watching the exact same pattern right now. But the example that should terrify you most happened much more recently. And most people still don't understand what actually occurred. Thomas Brennan was a fixed-income trader at Bear Stearns in 2007. He's 53 years old now, retired early, living in Connecticut on money he made shorting the housing market. But in June 2007, Thomas was sitting at his desk, watching something strange happen in the overnight lending markets. Banks were refusing to lend to each other. The overnight LIBOR rate, normally rock steady, was spiking erratically. Credit default swaps on major banks were widening. Thomas had been in the business 22 years. He'd seen stress before. But this felt different. This felt like the plumbing of the entire financial system was clogging. On August 9, 2007, BNP Paribas froze 3 investment funds, citing inability to value assets. The next day, the European Central Bank injected 95 billion euros in emergency liquidity. Within hours, the Federal Reserve followed with 24 billion. These were the largest emergency liquidity operations since September 11, 2001. Thomas knew what that meant. The central banks were scared, really scared. But here's what makes this story important. 6 weeks earlier, on June 20, 2007, Federal Reserve Chairman Ben Bernanke testified before Congress. His exact words: "We do not expect significant spillovers from the subprime market to the rest of the economy or the financial system." Everything is fine. The subprime issues are contained. No systemic risk. Thomas heard that testimony. He didn't believe it, because Thomas could see what Bernanke could see. The overnight lending markets were freezing. So either Bernanke was lying, or Bernanke was catastrophically incompetent. Years later, after the Fed released transcripts from their 2007 meetings, we learned the truth. In their private discussions, Fed officials were talking about severe stress in the banking system, liquidity concerns, potential contagion scenarios. They knew. They knew in June. They testified everything is fine in June. And in August, they deployed emergency facilities. 14 months later, Lehman Brothers collapsed and the financial system nearly ended. This is the microhook. Central banks don't fail to see crises coming. They see them clearly. They discuss them in private. They build infrastructure to manage them. But they cannot publicly acknowledge danger without triggering the crisis immediately. So they lie. Not because they're evil, because the system requires the lie to function. Now let me show you what they were actually doing while telling everyone everything was fine. On December 12, 2007, the Federal Reserve announced the creation of the Term Auction Facility, a new emergency lending program. But here's what most people get wrong about that announcement. They didn't create it in December. They'd been designing it for months. The legal frameworks, the operational procedures, the coordination with other central banks, all of it was built in advance. Then, when the crisis accelerated, they unveiled it as if it was a rapid response to unexpected events. The same pattern played out with the Primary Dealer Credit Facility, the Term Securities Lending Facility, the Commercial Paper Funding Facility. Every single emergency program deployed in 2008 was designed and ready before the public knew there was a crisis. They built the fire trucks before anyone smelled smoke, because they knew the building was already burning in the walls. Contrast Thomas, who saw the warning signs and positioned accordingly, with Jennifer Walsh. Jennifer was a bank manager at Washington Mutual in 2007. She's 47 years old, working as a compliance officer at a credit union now, after WAMU collapsed and destroyed her career. In June 2007, the same month Bernanke testified that subprime was contained, Jennifer's regional manager held a meeting for all branch managers in the Pacific Northwest. The message was clear. Ignore the negative headlines. Subprime issues are overblown. WAMU's mortgage portfolio is sound. Keep pushing home equity loans and adjustable-rate mortgages because the housing market is strong. Jennifer believed them. She trusted her leadership. She trusted the Fed chairman's testimony. She kept selling loans right up until September 25, 2008, when WAMU was seized by regulators in the largest bank failure in American history. Jennifer lost her job, her unvested stock options, and her belief that institutions tell the truth. Here's the question that haunts this pattern. If central banks could see the 2008 crisis coming clearly enough to build emergency facilities months in advance, why didn't they warn people? Why didn't they tell Jennifer's bosses at WAMU to stop making bad loans? Why didn't they tell depositors to move money from over-leveraged banks? The answer reveals the core mechanism of how central banking actually works. Central banks exist to preserve the system, not to protect individuals. When they see a crisis coming, their job isn't to warn the public. Their job is to build infrastructure to keep the system functioning when the crisis hits. And the infrastructure only works if most people don't see it coming. Because if everyone tries to exit at once, if everyone tries to save themselves simultaneously, the system collapses immediately. So central banks need most people to stay calm, stay invested, stay trusting, right up until the moment the infrastructure deploys. The Jennifers of the world must be sacrificed so the system survives. This isn't conspiracy. It's mechanism. It's the operating logic of crisis management when you're trying to save a system too fragile to survive the truth. Now bring this forward to March 2023. Remember Rebecca Martinez from Part 1? The Treasury analyst who discovered central banks were buying record amounts of gold while claiming their currencies were stable? Rebecca did what Thomas Brennan did. She trusted what she observed over what she was told. She saw the swap lines. She saw the gold buying. She saw Project Phoenix and the BIS white papers. And she understood that when central banks coordinate infrastructure while maintaining public calm, Phase 2 is coming. So she positioned her personal portfolio accordingly. Moved out of bonds, bought gold, increased exposure to hard assets. Her colleagues thought she was paranoid. Her boss told her she was overreacting. She ignored them. Because she'd studied 1927, 1968, and 2007, she knew the pattern, and the pattern never lies. Meanwhile, remember Michael Patterson, the Denver financial advisor, sending reassuring emails to clients about soft landings and steady markets? Michael is doing exactly what Jennifer Walsh did in 2007. He's trusting the official narrative. He's believing the presentations from headquarters. He's telling his clients their retirement accounts are positioned correctly because that's what the system needs him to believe and communicate. And when the infrastructure deploys, when the swap lines activate and the emergency facilities open and the crisis that central banks have been preparing for finally arrives, Michael's clients will lose money they were told was safe. Just like WAMU depositors lost money they were told was insured. The pattern always produces two groups: those who watch what central banks do, and those who believe what central banks say. The first group survives. The second group gets destroyed. There is no third option. And right now, in January 2025, we're in the preparation phase of a cycle that looks identical to those previous catastrophes. The swap lines are established. The gold is purchased. The backup systems are operational. The rehearsals are complete, all while official statements describe the economy as resilient and the financial system as sound. Phase 1 is almost complete, which means Phase 2, the deployment phase, is coming. Let me show you exactly what central banks are preparing for. Not theories, not speculation. The actual infrastructure they've built points to 5 specific crisis scenarios. And they're preparing for all 5 simultaneously. Because they don't know which will trigger first, but they know at least one is coming. And when it hits, the emergency systems they've constructed in secret will deploy while they act surprised. Just like 1929. Just like 1971. Just like 2008. The pattern never changes. Scenario 1. Treasury market dysfunction. The $26 trillion United States Treasury market is supposed to be the most liquid, stable, safe market in the world. It's the foundation of global finance. Every other asset is priced relative to Treasury yields. Every bank uses Treasuries as collateral. Every pension fund holds them as safe assets. The entire system assumes Treasuries can always be bought and sold instantly at transparent prices. But that assumption broke. Twice. In recent history. And central banks know it will break again. March 2020. COVID lockdowns begin. Markets panic. And for 3 days, the Treasury market ceased functioning normally. Bid-ask spreads that are usually 1 or 2 basis points exploded to 20, 30, 50 basis points. Nobody wanted to buy. Everyone wanted to sell. The safest asset in the world became temporarily untradeable. The Federal Reserve had to intervene with $1 trillion in emergency purchases over 2 weeks just to restore basic function. Then, in October 2023, it happened again. During a routine Treasury auction, liquidity evaporated. Prices moved erratically. The Fed quietly intervened through the standing repo facility, buying securities to stabilize the market. No press release, no announcement, just silent intervention to prevent dysfunction from becoming visible panic. Now look at what they're building. The standing repo facility has been expanded to include not just banks, but primary dealers, eligible money market funds, and foreign central banks. Capacity, unlimited. Availability, 24 hours a day, 7 days a week. They're not building this infrastructure for normal times. They're building it to keep the Treasury market functioning when it breaks again. Not if, when. Because they can see why it's going to break. David Castellano manages fixed income trading for a regional investment firm in Boston. He's 46 years old, been trading treasuries for 22 years. David still remembers the morning of March 18, 2020, sitting at his desk watching his Bloomberg terminal show treasury prices that made no sense. 10-year yields spiking while stocks crashed. Flight to safety that somehow made the safe asset more volatile. His phone rang constantly. Clients wanting to sell, counterparties refusing to buy, margin calls coming in from the clearinghouse. David had never seen anything like it. Treasuries aren't supposed to break. They're the bedrock. If treasuries don't work, nothing works. It took the Fed printing $1 trillion in 2 weeks to fix it. And even then, David knew it was just a patch. The underlying problem, too much debt, not enough real buyers, that problem didn't go away. Here's the problem they're not telling you about. $7.5 trillion in Treasury securities need to be rolled over in the next 12 months. That's $7.5 trillion in maturing bonds that must be replaced with new issuance. And the traditional buyers are walking away. China has reduced Treasury holdings by $300 billion since 2020. Japan, the second largest foreign holder, has been selling to defend the yen. Saudi Arabia is diversifying into euros and yuan. The foreign buyers who used to purchase 40% of new issuance are now net sellers. So who's going to buy $7.5 trillion in new debt when the traditional buyers are leaving? The only answer? The Federal Reserve. Through the emergency infrastructure they've already built. They'll call it necessary. They'll call it temporary. They'll call it stabilization. But what it actually is monetization. The government printing money to buy its own debt, because nobody else will. And that's the definition of a currency crisis. This is the first microhook. The Treasury market is going to break again. Not might, will. And when it does, the Fed will deploy unlimited buying through facilities they've already constructed. They're not building fire trucks hoping there won't be a fire. They're building fire trucks because they've already seen the smoke. Scenario 2. Commercial real estate implosion. This one has already happened. It's just moving slowly enough that most people don't see it yet. $20 trillion in U.S. commercial real estate. $1.5 trillion in commercial real estate loans maturing between 2024 and 2026. These loans were originated when offices were 95% occupied and interest rates were 2 to 3%. Today, offices in major cities are 50% occupied. Interest rates are 7 to 8%. The math doesn't work anymore. A building that was worth $100 million at 3% rates and 95% occupancy is worth $40 million at 8% rates and 50% occupancy. But the loan is still for $70 million. The building is underwater. The borrower can't refinance. The bank can't foreclose without recognizing the loss. So they extend and pretend. A 2023 study by the National Bureau of Economic Research found that 385 U.S. banks face potential insolvency if commercial real estate prices decline by 20% from 2019 levels. They've already declined by 35% in major markets. So why haven't these banks failed? Because regulators are allowing them to not mark these loans to market value. They're carrying buildings on their books at 2019 prices, even though everyone knows they're worth far less. This is systematic accounting fraud At the regulatory level. Patricia Nguyen worked as a commercial real estate appraiser in San Francisco until 2023. She's 39 years old, now working for a property management company after her appraisal firm lost most of its clients. Patricia remembers the day in May 2023 when her boss called her into his office and showed her a loan file. A downtown office tower, 12 stories, appraised at $85 million in 2019 when the loan originated. The bank was requesting a new appraisal for loan extension. Patricia did the analysis. 50% occupancy. Comparable sales at 40% of 2019 prices. Current market value, $34 million. The loan balance, $62 million. She wrote up the appraisal showing $34 million. Her boss told her to revise it. The bank needed $60 million to avoid recognizing the loss. Patricia refused. Her boss revised it himself, signed it with his credentials, and submitted $60 million. 2 weeks later, Patricia was laid off. She later learned that her boss's firm appraised 47 buildings that year. Every single appraisal came in at exactly the value the bank needed to avoid marking losses. This is happening nationwide, systematically, with regulatory approval. Now look at what the Fed built after Silicon Valley Bank collapsed in March 2023. The Bank Term Funding Program. This facility allows banks to borrow against securities at par value, face value, regardless of their current market price. A bond worth 70 cents on the dollar can be pledged for 100 cents in cash. The Fed is letting banks borrow against assets that have lost value as if those assets were still worth full price. Why? Because if banks had to recognize real losses, hundreds would fail immediately. So the Fed created a facility to keep zombie banks operating. Here's the rage moment. Pause this video for 10 seconds and think about this. The Federal Reserve created a program that lets insolvent banks stay open by borrowing taxpayer money against worthless collateral. When those banks eventually fail anyway, who loses? Not the bank executives who made the bad loans. Not the regulators who allowed the fraud. Not the appraisers who lied on valuations. The depositors lose. The taxpayers lose. The people who trusted that FDIC insured meant safe. The system socializes losses while privatizing gains. The banks gamble. The public pays. And the central bank builds the infrastructure to make sure the game can continue as long as possible before the inevitable collapse. Contrast Patricia, who lost her job for telling the truth, with Richard Whitmore. Richard is a managing director at a major commercial bank in New York. He's 54, earned $4.2 million in compensation last year. Richard's bank has $12 billion in commercial real estate loans on its books. $8 billion are underwater. But they don't show as impaired because appraisers like Patricia's boss certify values that allow the loans to appear current. Richard knows this. Everyone in the C-suite knows this. But as long as regulators allow the fiction and the Fed provides liquidity through emergency facilities, the game continues. Richard will collect bonuses for years. When the bank eventually fails, he'll be retired in the Hamptons. The depositors will be in line at bankruptcy court. This is the second microhook and the unexpected twist. Central banks aren't preventing crises. They're prolonging them. They're building infrastructure to keep insolvent institutions operating longer, extracting more value, creating bigger losses that will eventually need bigger bailouts. The emergency facilities aren't safety nets. They're time bombs. Scenario 3. Programmable control through central bank digital currencies. 107 countries, representing 95% of global GDP, are now exploring or piloting CBDCs. The Federal Reserve is testing FedNow. The European Central Bank is advancing the digital euro. The Bank of England is designing Britcoin. Their public justification is always the same: efficiency, financial inclusion, innovation. But look at the capabilities they're actually building. Programmable money that allows central banks to set rules on how currency can be spent. Expiration dates, so money disappears if not used within certain timeframes. Geographic restrictions, so money only works in approved locations. Negative interest rates, hard-coded, so money loses value if you save it. The ability to freeze accounts, reverse transactions, and monitor every purchase in real time without warrants or court orders. Here's what most people get wrong about CBDCs. They think it's about replacing physical cash with digital convenience. It's not. It's about control. In 2008, central banks cut rates to zero and did quantitative easing. They created trillions in new money and hoped people would spend it. But people saved. Businesses hoarded cash. The velocity of money collapsed because everyone was terrified. The stimulus didn't stimulate. Next time, they don't want to hope. They want to guarantee. And CBDCs give them that power. Money that expires forces spending. Money that can't be saved forces consumption. Money that only works in certain sectors directs economic activity. Central banks are building the infrastructure for direct monetary control over individual behavior. Elena Vasquez testified before the European Parliament in November 2024 about CBDC privacy concerns. She's a 32-year-old privacy advocate from Barcelona who's been fighting the digital euro rollout. Elena's testimony included leaked documents from ECB planning meetings showing features that were never publicly disclosed. Transaction monitoring thresholds as low as €100. Automatic tax withholding on all transactions. Geolocation tracking embedded in payment protocols. The ability to restrict purchases of certain goods from certain people based on social credit scores. When Elena presented these documents, she was told the features were theoretical possibilities being explored and not intended for implementation. 6 months later, the ECB published updated technical specifications. Every feature Elena warned about was included. The question nobody's asking: if these are just efficiency upgrades, why do they need the ability to freeze accounts without judicial review? Why do they need expiration dates? Why do they need to track every transaction in real time? The answer is scenario 3. When the next crisis hits, the treasury market dysfunction, the commercial real estate collapse, the sovereign debt crisis, central banks need the ability to force economic behavior. They need to be able to stop bank runs by freezing withdrawals. They need to force spending by making money expire. They need to prevent capital flight by restricting geographic usage. The infrastructure isn't for normal times. It's for the crisis they see coming. Scenario 4. The sovereign debt death spiral. Global debt is now $307 trillion. 336% of global GDP. The United States federal debt alone is $34 trillion and growing by $1 trillion every 100 days. Interest payments on U.S. debt are now $1.1 trillion annually. That's more than defense spending, more than Medicare. At current interest rates, debt service consumes 18% of all federal tax revenue. Picture this as a household budget. Imagine you earn $100,000 per year. $18,000 goes just to paying interest on your credit cards, not paying down principal, just interest. Now imagine interest rates rise. At 6% rates, that number hits $30,000. At 8%, it hits $40,000. You're not servicing debt anymore. You're borrowing new money to pay interest on old money. That's the mathematical definition of a debt-death spiral. Governments facing this trap have exactly 2 options. Option 1. Default. Announce you cannot pay. Bonds become worthless. Pension funds collapse. Social Security stops. Political suicide. Option 2. Inflate. Print money to buy your own debt. Service obligations with currency you create. Watch the currency lose value, but avoid default. Politically survivable, because most voters don't understand inflation until it's too late. Every government in history facing this choice picks option 2. Not because it's ethical, because it's survivable. Now look at what central banks are preparing. Yield curve control. The Bank of Japan has been doing it for years. The mechanism is simple. The central bank announces it will enforce specific interest rates on government bonds at specific maturities. 10-year bonds will yield exactly 1%. If market rates rise above that, the central bank prints money and buys bonds until the yield falls back to 1%. Unlimited buying. Guaranteed rates. It's the ultimate control mechanism. It's also the ultimate currency destruction mechanism. Because when you print unlimited money to hold rates down, while debt grows exponentially, you're devaluing the currency. The bondholders get paid back in money worth less. The government inflates away its debt burden. The savers and retirees holding that currency get destroyed. Marcus Holbrook is 74 years old, a retired aerospace engineer living in Seattle. He worked for Boeing for 41 years, saved carefully. Retired in 2018 with $1.2 million in Treasury bonds and Treasury money market funds. Safe, conservative, responsible. That's what every financial advisor told him Treasuries were. In 2020, the Fed cut rates to 0 to fight COVID. Marcus's yield income dropped from $48,000 annually to $8,000. He had to draw down principal to cover expenses. By 2024, his portfolio was down to $900,000. Not because he spent recklessly, because the Fed destroyed the yield on safe assets. Now Marcus sees headlines about yield curve control being discussed as a policy option. If implemented, the Fed will print unlimited money to keep Treasury yields low indefinitely. Marcus will never earn income on his bonds again. The $1.2 million he saved over 41 years will be slowly drained until he's dependent on Social Security. Marcus did everything right. Worked his whole life. Saved conservatively. Trusted Treasury bonds. And the central bank is systematically destroying him to manage a debt crisis created by government spending he didn't vote for and policies he didn't support. Scenario 5. The end of dollar reserve status. Since 1944, the U.S. dollar has been the world's reserve currency. 59% of global foreign exchange reserves are dollars. 85% of all forex transactions involve dollars. This privilege lets America print money and export inflation. Other countries must hold dollars to trade, so they absorb the monetary expansion. We print, they pay. But that system is ending. In 2023, 23% of China's cross-border transactions were settled in yuan, up from 0% in 2010. The BRICS nations, Brazil, Russia, India, China, South Africa, are developing alternative payment systems to bypass the dollar. Saudi Arabia, which has priced oil exclusively in dollars since 1974, is now accepting yuan for oil sales to China. The petrodollar is dying, and when it dies, America loses the ability to export inflation. The Bank for International Settlements published a report in December 2023 titled The Future Monetary System. Buried on page 47 is this statement: central banks should prepare for scenarios where multiple reserve currencies operate simultaneously. Translation: they know dollar dominance is ending. They're preparing for a multipolar monetary system. And when that transition happens, the $34 trillion in U.S. debt becomes an immediate crisis. Because we can't just print money and have other countries hold it anymore. The inflation we've been exporting for 50 years comes home. And it comes home all at once. Here's the final unexpected twist. Central banks can't publicly acknowledge any of these 5 scenarios without triggering them immediately. If the Fed admits concern about Treasury dysfunction, investors sell Treasuries, causing dysfunction. If they admit commercial real estate problems, depositors run from banks. If they discuss CBDC control features, privacy advocates kill adoption. If they acknowledge the debt spiral, bond markets collapse. If they admit dollar reserve status is ending, foreign holders dump immediately. They're trapped by their own credibility. The system only works as long as everyone believes it's stable. So they build the infrastructure in secret, coordinate internationally in silence, buy gold while claiming currencies are strong, and wait for the crisis they know is coming while telling you everything is fine. This isn't conspiracy. This is mechanism. The emergency swap lines, the repo facilities, the CBDC infrastructure, the yield curve control preparations, the gold reserves. Every piece exists because they see these 5 scenarios approaching. They're not preventing crisis. They're building the tools to maintain control during crisis. And the people who believe official statements instead of watching actual preparations will be the ones destroyed when deployment begins. The infrastructure is complete. The coordination is done. The rehearsals have finished. All that's left is the trigger. And given 5 scenarios, at least one will trigger soon. When central banks deploy the infrastructure they've been building, the destruction doesn't happen overnight. It happens slowly, methodically, like watching a glacier move. You can't see it shifting minute to minute, but over years, it grinds everything in its path to dust. Let me show you what the next decade looks like when emergency systems designed to stabilize actually accelerate the wealth transfer from the many to the few. Remember Marcus Holbrook from Part 3? The 74-year-old retired Boeing engineer with $900,000 in treasury bonds after the Fed destroyed his yield income? Let's project Marcus forward in 5-year increments. 2025. Marcus is 75. The Fed implements yield curve control to manage the debt spiral. 10-year Treasury yields are capped at 2%, despite inflation running 6 to 8% annually. Marcus earns $18,000 per year on his $900,000 portfolio. His living expenses, medical insurance, property taxes, food, utilities, run $62,000 annually. He draws down principal by $44,000 per year just to survive. 2030. Marcus is 80. His portfolio is down to $680,000 after 5 years of $44,000 annual drawdowns. But inflation has compounded. His expenses are now $91,000 annually. His yield income at 2% is $13,600. He's now drawing down $77,000 per year. The math is accelerating against him. 2035. Marcus is 85. His portfolio has $190,000 left. His expenses are $134,000 annually. Even liquidating everything, he has less than 18 months of money remaining. Marcus worked 41 years, saved over $1 million, invested conservatively in the safest assets on Earth, and the central bank's yield curve control policy systematically destroyed him over 10 years. He'll die dependent on Social Security that doesn't cover his medical costs. This is the slow-motion annihilation of the responsible saver class. Now contrast Marcus with Rebecca Martinez, the Treasury analyst from Part 1, who saw central banks buying gold and positioning accordingly. Rebecca is 41 in 2025. Her net worth is $480,000, half in gold and mining stocks, 30% in dividend-paying equities, 20% in Treasury inflation-protected securities. When the Fed implements yield curve control in 2025, regular treasuries get destroyed. But TIPS, indexed to inflation, maintain purchasing power. Rebecca's dividend stocks increase payouts as companies raise prices with inflation, and her gold position explodes as investors flee yield-suppressed bonds and realize central banks were buying for a reason. 2030. Rebecca is 46. Her portfolio is worth $870,000 in nominal terms, $620,000 in 2025 purchasing power. She gained real wealth. 2035. Rebecca is 51. Her portfolio is $1.4 million nominally, $750,000 in real terms. She'll retire at 55, 25 years before Marcus could have, if he'd survived. Same decade, same monetary policy, opposite positioning. Marcus trusted official narratives about treasury safety. Rebecca watched what central banks actually did. The difference in outcome isn't luck. It's information asymmetry. Here's what most people get catastrophically wrong about this timeline. They think when emergency systems deploy, there's a dramatic crash and then recovery. There isn't. There's a slow degradation that compounds over years until people wake up one day and realize they're destitute, but can't identify the exact moment it happened. Picture two lines on a graph diverging over 10 years. The top line is asset holders like Rebecca, rising nominally, maintaining or gaining in real terms. The bottom line is currency holders like Marcus, flat nominally, but falling off a cliff in purchasing power. The gap between those lines represents the largest wealth transfer in modern history, and it's already happening. Let me show you this playing out in commercial real estate. Remember Patricia Nguyen, the San Francisco appraiser who lost her job for telling the truth about building values? And Richard Whitmore, the bank managing director earning $4.2 million while his bank carries $8 billion in underwater commercial real estate loans. Let's extend both trajectories. 2026. Patricia is 41, working property management, earning $68,000 annually. She rents a one-bedroom apartment for $3,200 monthly. She watches office buildings in downtown San Francisco sit empty. She knows those buildings are collateral for billions in bank loans. She knows the loans are fraudulently valued. She waits for the collapse. 2028. It comes. Not as a sudden crash, as a wave of quiet loan extensions and modifications. Banks don't foreclose because that would force loss recognition. Regulators don't intervene because that would trigger failures. The Fed's Bank Term Funding Program keeps extending, keeps providing liquidity against worthless collateral. The buildings stay on bank books at 2019 values, even though they're 40% occupied and generating negative cash flow. Patricia watches this and realizes the system has no intention of recognizing reality. Ever. The zombie buildings will stay zombie buildings until the entire banking system is zombie banks. 2030. Patricia is 44, still in property management, still renting. Her salary is $79,000 nominally, worth $61,000 in 2025 purchasing power. She's going backward. Meanwhile, the office building she appraised in 2023, the one her boss fraudulently valued at $60 million when it was worth $34 million. That building is still on the bank's books at $58 million after a small markdown for appearance. It's 30% occupied. Market value is maybe $18 million. The loan is still for $62 million. But the bank is still operating, still paying bonuses, still telling depositors their money is safe. Because the Fed's emergency facility lets them borrow against the fake $60 million valuation. 2035. Patricia is 49. Her salary is $92,000 nominally, $56,000 in real terms. She's lost ground for 10 years straight. She'll never own property in San Francisco. She'll retire poor. Meanwhile, Richard Whitmore, the managing director whose bank holds $8 billion in underwater loans. 2026. Richard is 56. His bank takes small write-downs, 3% of the portfolio, to show they're being prudent. Not enough to threaten solvency, just enough to maintain credibility. Richard's bonus is $3.8 million. 2028. The commercial real estate market continues deteriorating. Richard's bank has now written down 9% of the portfolio, still carrying buildings at values everyone knows are fiction, still borrowing from the Fed's facility. Richard's compensation is $4.1 million. 2030. Richard retires at 60. His total compensation over the 5 years since we met him, $21 million. His bank is still operating, still lying about asset values, still paying executives millions, while the portfolio rots. 2035. Richard is 65, living in the Hamptons with $38 million in net worth. His bank finally fails in 2034 when the Fed's emergency facility expires and nobody will roll over the commercial real estate loans. Depositors lose money. Shareholders are wiped out. Bondholders get pennies. But Richard is fine. He extracted his wealth before the collapse. Patricia, who told the truth and lost her job in 2023, never recovered. Richard, who perpetuated the fraud for a decade, retired rich. This is the first micro-hook. The system rewards participants in fraud and punishes truth-tellers. Not accidentally, structurally. Because the emergency infrastructure central banks build is designed to keep the fraud operating as long as possible. And the people positioned inside the fraud have years to extract wealth before it collapses. Now let me show you what happens at the sovereign level. The United States is running this experiment in real time. But we can look at Japan to see the endgame. Japan has been doing yield curve control since 2016. They capped 10-year government bond yields at 25 basis points, essentially zero, by printing unlimited yen to buy bonds. This keeps government borrowing costs low. It also destroys savers and creates zombie banks and corporations that survive on cheap debt but produce no value. The result? Japan's economy has had near-zero real growth for 30 years. Wages are stagnant. Young people can't afford homes. Birth rates have collapsed. But government debt as a percentage of GDP hit 264%, and nobody notices anymore because the central bank owns so much debt that the fiction of solvency can be maintained indefinitely. Japan didn't collapse. It just slowly died. Companies that should have failed in the 1990s are still operating in 2025, kept alive by zero-interest loans from banks that should have failed in the 2000s, kept alive by the Bank of Japan buying their bonds. It's zombies all the way down. And the human cost is measured not in dramatic crashes, but in generations that never accumulate wealth. Visualize this as a timeline stretching from 1990 to 2025. At the top, Japanese government debt climbing from 60% of GDP to 264%. At the bottom, median household wealth adjusted for inflation, flat for 35 years. The gap between those lines is the transfer. Government offloads debt burden through yield suppression. Citizens absorb the loss through destroyed savings and stagnant wages. The system doesn't collapse. It just converts a prosperous middle class into a permanent renter class over 3 decades. This is the second microhook and the unexpected twist. The worst-case scenario isn't collapse. Collapse would be fast, visible, solvable. The worst case is what Japan proves is possible. Decades of zombie economics where the system stays technically functional, but ordinary people never build wealth. And America is implementing the exact same policies Japan pioneered. Here's the question nobody's asking. If Japan has been doing yield curve control for 9 years, and it obviously destroys savers. Why is the Fed preparing to implement it? The answer? Because there's no alternative. The $34 trillion debt cannot be serviced at market rates. Period. At 8% rates, interest payments alone consume 40% of tax revenue. The government cannot function. So the Fed will cap rates through unlimited bond buying. They'll call it necessary. They'll call it temporary. It will be neither. It will be permanent yield suppression that runs for decades, just like Japan. And just like Japan, it will create a generation of Americans who work their entire lives and never accumulate wealth. Let me show you one more trajectory that captures the generational aspect. Emily Carter is 28 years old in 2025. She's a high school teacher in Austin, Texas, makes $54,000 annually, has $18,000 in student debt, $3,200 in savings. She wants to buy a house someday, have kids, build the life her parents had. But her parents bought their house in 1998 for $140,000 on a 30-year mortgage. They paid it off in 2028. That house is now worth $480,000. Emily can't afford a starter home in Austin. They're $520,000 and rising. Her salary increases 3% annually. Housing prices increase 8%. The gap widens every year. 2030. Emily is 33, earns $63,000, has saved $41,000 total. Starter homes are now $700,000. She needs $140,000 for down payment. She's $99,000 short. 2035. Emily is 38, earns $74,000, has saved $78,000. Starter homes are $1.03 million. She needs $206,000 down. She's $128,000 short. She's been working full-time, saving aggressively for 10 years, and she's further from homeownership than when she started. Emily will never own a home. She'll rent forever. She'll retire with no equity. She'll pass nothing to her children. Not because she's lazy or irresponsible, because asset inflation outpaced wage growth by such a margin that accumulation became mathematically impossible. Contrast Emily with Brandon Chen, also 28 in 2025. Brandon's parents gave him $80,000 for a down payment when he graduated college. Brandon bought a condo in Austin in 2023 for $400,000 with that gift. 2030. Brandon is 33. His condo is worth $640,000. He owes $290,000. Equity, $350,000. 2035. Brandon is 38. His condo is worth $940,000. He owes $260,000. Equity, $680,000. Brandon worked no harder than Emily. He just had family wealth at the exact moment asset inflation was accelerating. That initial advantage compounds into $1 million wealth gap over 15 years. Emily works forever. Brandon retires early. Same city, same jobs. Opposite outcomes determined entirely by whether you had assets before the central bank emergency policies destroyed currency. Here's the second unexpected twist. This isn't temporary wealth inequality, it's permanent structural separation. When you suppress yields, inflate assets, and run this policy for decades, you create a two-tier system. The asset-owning class and the permanent renter class. No amount of hard work lets you cross that divide once it's established. Emily can't work hard enough to catch up. The math won't let her. This is what yield curve control does over time. It doesn't cause a crash, it causes stratification. The people with assets, when the policy starts, consolidate. Everyone else stays poor forever. Now bring this back to central banks' silent preparation. The swap lines, the gold buying, the emergency facilities, the CBDC infrastructure. All of it is designed to implement these exact policies when the crisis triggers. They're not preventing the outcomes I just showed you. They're guaranteeing them. Because the infrastructure they've built enables unlimited money printing to suppress yields, unlimited liquidity to keep zombie institutions operating, unlimited intervention to prevent market clearing. And the people who see this coming and position accordingly, the Rebeccas, the Richards, the Brandons, they survive or thrive. The people who trust official narratives, the Marcuses, the Patricias, the Emilys, they get destroyed over a decade so slowly they never identify the exact moment their future died. The emergency systems are ready. The rehearsals are complete. The gold is vaulted. The coordination is synchronized. All while financial advisors like Michael Patterson from Part 1 send emails to clients about diversified portfolios and long-term holds and staying the course. Those clients are Marcus. They're Emily. They're everyone who doesn't understand that when central banks prepare in secret, the preparation is for a managed decline that transfers wealth upward over years, not a crash, a grinding, compounding, irreversible transfer. And it's not starting soon. It already started. The 5-year countdown began when they created those swap lines in March 2023, which means we're halfway to the outcomes I just showed you. January 2025. We're sitting at the exact midpoint of the pattern. The infrastructure is built. The coordination is complete. The emergency systems are operational. And the public narrative is still, everything is fine, markets are resilient, the economy is strong. We've seen this movie before, 3 times in the past century. And every single time, the people who watched what central banks did survived. The people who believed what central banks said got destroyed. Let me bring you back to the 2 people who opened this story. Rebecca Martinez, the 41-year-old Treasury analyst who saw central banks buying record gold in 2023 while claiming currencies were stable. And Michael Patterson, the 34-year-old financial advisor in Denver who believed the presentations from headquarters about soft landings and steady markets. 2 years have passed since we met them. Let's see where they are now. Rebecca is 43. She's still at the same bank, still analyzing central bank behavior, still watching the gap between official statements and actual actions widen. In March 2023, she saw the swap lines and repositioned her personal portfolio, moved out of long-duration bonds, bought gold, increased exposure to inflation-protected securities and dividend-paying equities. Over the past 2 years, her colleagues have mocked her. Gold is a dead asset. You're missing the bond rally. You're being paranoid. But Rebecca watched what happened in those 2 years. The Fed implemented standing repo facilities with unlimited capacity. The BIS launched Project Phoenix backup systems. Central banks purchased another 1,847 tons of gold in 2024, the second highest year on record. Every single piece of infrastructure she predicted would be built was built. Her portfolio is up 18% in nominal terms, 12% in real terms. More importantly, she's positioned for what comes next. When the Treasury market breaks again, not if, when, her inflation-protected securities will preserve purchasing power while regular bonds get destroyed. When yield curve control deploys, her gold position will surge as investors flee suppressed yields. Rebecca isn't hoping the system stays stable. She's positioned for the deployment she knows is coming. Michael is 36 now. He's still sending quarterly emails to clients about diversified portfolios and long-term thinking. His clients hold traditional 60-40 portfolios, 60% stocks, 40% bonds. Those bonds are paying 4 to 5% yields now after the rate hikes of 2022 to 2023. It looks safe. It feels stable. Michael's clients trust him. They trust the system. They have no idea that the bonds they hold as safe assets will be the first things destroyed when the Fed implements yield curve control to manage the debt crisis. Michael doesn't know about the swap lines. He doesn't follow central bank gold purchases. He doesn't read BIS white papers. He knows what CNBC tells him and what his firm's chief investment officer presents at quarterly meetings. And the message is always the same. Stay diversified, stay invested, trust the process. Michael's clients are going to lose 40 to 60% of their bond purchasing power over the next decade, and Michael won't understand why, because he never learned to watch what central banks do instead of what they say. Here's the pattern that's run through everything we've discussed. 1927. Secret coordination, rate cuts to save the pound, public statements about sound policy. 1929. Crash. Destroys people who believed official narratives. 1968. Secret gold pool defense. Public statements about stable currency. 1971. Devaluation. Destroys savers who trusted the system. 2007. Emergency swap lines created. Bernanke testifies subprime is contained. 2008. Collapse. Destroys people who believed everything was fine. And now, 2023. Unlimited swap lines established. Record gold buying. Backup financial systems built. CBDCs developed. Yield curve control prepared. All while official statements describe the economy as resilient and the financial system as sound. The pattern doesn't just rhyme, it's identical. Infrastructure first, coordination second, public reassurance third, crisis deployment fourth. The only variable is timing. And here's what you need to understand about timing. Central banks don't control when the crisis triggers. They control what happens after it triggers. The treasury market dysfunction, the commercial real estate collapse, the sovereign debt spiral, the end of dollar reserve status. These aren't things they can prevent. These are mathematical inevitabilities. 7.5 trillion in treasuries rolling over with no buyers. 1.5 trillion in underwater commercial real estate loans maturing. 34 trillion in federal debt requiring yield suppression to service. 59% global dollar reserves declining as BRICS builds alternatives. The numbers don't lie. The crisis is baked in. What central banks have been preparing for is not prevention, it's control. When the treasury market seizes, they'll deploy unlimited repo. When commercial banks fail, they'll activate emergency lending. When the debt becomes unserviceable at market rates, they'll implement yield curve control. When dollar reserve status fragments, they'll use the swap lines to manage the transition. Every piece of infrastructure they've built has a specific trigger and a specific deployment scenario. And they've practiced the deployments in those resolution planning exercises they've been running since 2020. Here's the framework you need to ask yourself. Not financial advice, not predictions, just questions for clarity. First, do I understand the difference between what central banks say publicly and what they're preparing for privately? If you're listening to Fed press conferences and financial media, you're hearing the public narrative. If you're watching swap line creation, gold buying, emergency facility expansion, and infrastructure building, you're seeing the private preparation. Second, am I positioned like someone who believes official statements or like someone who watches actual behavior? If your wealth is in long-duration bonds, cash, or assets denominated in currencies central banks are debasing, you're positioned to lose. If you're in hard assets, inflation protection, or things that maintain value when currencies devalue, you're positioned to survive. Third, do I have time to reposition before deployment begins? This is the critical question, because once the infrastructure deploys, once the Fed announces yield curve control, once the swap lines activate at scale, once emergency facilities open to prevent bank failures, it's too late. The wealth transfer will already be in motion. What most people don't understand is that central bank emergency deployments aren't go-yen actions. They're wealth transfer mechanisms disguised as go-yen actions. When the Fed cut rates to zero in 2008 and did quantitative easing, they weren't saving the economy. They were transferring wealth from savers to asset holders. When the Bank of Japan implemented yield curve control, they weren't stabilizing markets. They were destroying an entire generation of savers to keep government debt serviceable. When the Fed created the Bank Term Funding Program to let insolvent banks borrow against worthless collateral, they weren't preventing crisis. They were socializing losses while letting insiders extract value before collapse. Every emergency deployment in history has the same result. The people who see it coming and position early survive or thrive. The people who trust official narratives get destroyed. Visualize this as a final image, a massive room with two doors. One door is labeled Official Narrative, Stay Calm, Stay Invested, Trust the System. That door is wide open. Bright lights, comfortable chairs, financial advisors like Michael, standing there with reassuring smiles and quarterly reports. 95% of people walk through that door because it feels safe, and everyone they trust says it's the right choice. The other door is labeled, Watch what central banks actually do. That door is narrow, dimly lit. You have to seek it out. But through that door are people like Rebecca, positioned for what's coming, holding assets that will survive the deployment, understanding that emergency infrastructure exists because emergency deployment is inevitable. 5% of people walk through that door. And over the next decade, those 5% will preserve or build wealth, while the 95% watch their purchasing power slowly destroyed. Here's the unexpected final twist. You don't need insider information to see which door is real. Everything I've shown you in this video is public information. The swap lines were publicly announced. The gold purchases are publicly reported. The BIS white papers are publicly available. The emergency facilities are publicly documented. The rehearsal exercises are publicly disclosed. Central banks aren't hiding their preparation. They're just not explaining it, because explanation would trigger panic. But observation reveals everything. The infrastructure tells you what's coming. The coordination tells you it's serious. The gold buying tells you they don't trust their own currencies. And the public statements saying everything is fine tell you they need you calm until deployment begins. This isn't about predicting the future. This is about understanding the present. Central banks have already told you what's coming, not through their words, through their actions. And the actions say, prepare for treasury dysfunction, commercial real estate collapse, debt crisis, currency devaluation, and reserve currency transition. Not one of these, all of these, simultaneously or in rapid succession. The emergency infrastructure isn't built for isolated problems. It's built for systemic breakdown. And when it deploys, there will be two groups: those who position before deployment and those who trusted official statements. There is no third group. We opened this video with a paradox: central banks buying record gold while claiming currencies are stable. Now you understand it's not a paradox. It's a signal. They're preparing for currency instability they can't publicly acknowledge. We showed you the pattern repeating across a century. Now you understand it's not coincidence. It's mechanism. Coordinate in secret, build infrastructure, maintain public calm, deploy during crisis, Transfer wealth from the unprepared to the positioned. We showed you 5 scenarios they're preparing for. Now you understand they're not preventing these scenarios. They're building the tools to maintain control while the scenarios unfold. The signature line that captures everything. They're not planning for a crisis. They're rehearsing for one. And when central banks rehearse, it's because the performance date is already scheduled. January 2025. The swap lines are permanent. The gold vaults are full. The backup systems are operational. The rehearsals are complete. Phase 1 is ending. Phase 2, the crisis they've been preparing for, is approaching. And the only question that matters is which door you walk through. The comfortable one with reassuring statements and traditional portfolios, or the narrow one where you position like central banks position, not like they tell you to position. History doesn't repeat, but it rhymes. And right now, it's rhyming in perfect cadence with 1927, 1968, and 2007. The pattern never fails. The mechanism always transfers wealth the same direction. And the people who survive are always the ones who watched what central banks did, while everyone else listened to what central banks said. The moment they stop saying everything is fine, it will already be too late.